Americans can rest assured that our banking system is safe.
Silicon Valley Bank has collapsed and federal regulators have taken control.
Try and stem any sort of contagion effect.
Impacting tech startups, leaving customers in limbo.
Raising concerns about the broader economy.
Attention investors and workers, the era of free money from the Federal Reserve has come to an end, signaling a significant shift in the economic landscape. The recent developments in interest rates have caused a wave of uncertainty in the financial markets and the economy, which may have profound effects in the near future ahead. If you're wondering how these changes will impact your investments and financial decisions, then watch this video until the end to discover the potential risks and opportunities in this new economic reality. But before that, make sure to subscribe to this new channel to see more videos about economy and interesting economic facts from around the world. So without further ado, let's start. The United States has recently bid farewell to the era of easy money from the Federal Reserve, signifying a shift towards a new economic phase. This transformation was triggered by a series of decisions made by the Federal Reserve, which led to a substantial increase in the federal funds rate, raising it by 500 basis points in just over a year. That was the fastest tightening movement in the FED's history, and this tightening of monetary policy is expected to continue, exerting a profound impact on Wall Street and the financial landscape for individuals across America and the world. Now, there is no doubt that the United States has entered a new economic era. This week's developments have generated mixed reactions, leaving many pondering whether it's the right time to invest and expend money or adopt a more cautious approach. That's because for the past 15 years, the country has enjoyed a period of low inflation, which correspondingly translated into historically low interest rates. However, the repercussions of these policies are now becoming apparent, with potential negative consequences. During this extended period of low inflation, central bankers took advantage of the situation by keeping interest rates at record lows. As a result, the economy boomed and job opportunities increased, particularly for those in lower income brackets. Another benefit was the birth of the lengthiest stock bull market in history, which created massive wealth for investors. However, the current economic landscape signals a significant departure from this familiar environment, and individuals and investors must navigate these changes carefully. This week, the Federal Reserve continued its path towards ending the era of free money by raising interest rates by another 0.25%, resulting in the highest rate in 22 years, now standing between 5.25 and 5.5%. However, the real interest rate, known as the prime rate, is typically 2 to 3% higher than the federal funds rate, which banks use to borrow money from each other, and is also used as a benchmark in setting home equity lines of credit and credit card rate. With that, the real economy continued to experience repercussions, such as the breakdowns of smaller regional banks, including the unnoticed collapse of PAC West Bank and the very noticed Silicon Valley Bank. Unfortunately, things might get hairier for the banking systems before they improve. That's because a few worrisome economic trends will only put more pressure on regional banks in the coming months. The first of these is the flailing commercial real estate market. About 30% of the assets at the nation's 4,500 small to medium-sized banks are commercial real estate loans, a higher percentage than the industry average, and a lot of those loans are now maturing. The second is the impact on other loans' interest rates, such as new car loans, used car loans, and credit card interest. Another major concern is that the ongoing banking stress will quickly translate into a credit crunch. A severe credit crunch looms large, as regional and other lenders have already tightened their lending standards, which will reduce credit availability. The impacts will be immediately felt by small businesses and low-income households, who rely primarily on such banks for credit. Despite these developments, the Federal Reserve remains optimistic about the economy, citing a slowdown in inflation and low unemployment rates. Another data pointed by the FED is the stock market's impressive performance, with the Dow Jones Index experiencing its best run in 36 years. Given the uncertainties arising from the end of the era of ultra-low interest rates and quantitative easing in 2022. The question of whether it is the right time to invest in the stock market and spend money or wait for a possible recession in 2024 has become more relevant than ever. That's because as interest rates have risen, the stability of asset prices has been significantly impacted. Stock markets have experienced notable volatility, although valuations remain relatively high. As we step into the new year, uncertainty looms large on the horizon. Apart from geopolitical tensions and energy concerns, the most significant questions revolve around the direction of inflation and monetary policy. If inflation shows signs of rapid decline and the unemployment rate remains lower, we may witness an easing in monetary policy. However, if inflation persists, the likelihood of such an easing diminishes. As we grapple with this uncertainty, it becomes essential for each of us to closely monitor the outlook for monetary policy as it directly affects our financial decisions in the broader economic landscape. Rising interest rates are expected to have adverse consequences as they make debt more expensive. Amidst the prevailing uncertainty, market volatility is likely to persist, leading to a potential shakeout of overbought assets and an increase in defaults. If interest rates continue to climb, the likelihood of defaults will only escalate, impacting not only developing and emerging economies, where distress is already evident, but also highly leveraged ventures in high-income countries. The income is still uncertain, and it remains to be seen which perspective will prevail. The extent and pace of inflation's decline, along with the level of real interest rates, will ultimately determine how much the future differs from the pre-inflationary period. As of now, we find ourselves in a period of higher interest rates and a recalibration of risk. This presents both dangers and prospects for investors in the broader financial landscape. The current environment offers a mix of risks and opportunities that will shape the path forward. That makes us always remember the old saying, never waste a good crisis. Or in other words, when a crisis occurs, it must be seized as an opportunity. In the coming months, we may have a lifetime and generational opportunity to create massive wealth. In a nutshell, despite the end of free money at the Federal Reserve and the new economic landscape, rising interest rates and inflation create uncertainty and opportunity for investors and workers. Careful monitoring of market trends will be crucial for navigating this evolving financial reality. Embrace the challenges, stay informed, and be prepared to seize opportunities amidst the changing economic terrain. Well, now that you know more about the end of free money by the FED, don't forget to like the video and subscribe to our channel to see new videos about economy and interesting economic facts from around the world. And don't forget to turn on that notification bell, and we'll see you in the next one. Until next time, goodbye.